What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 27th of 2019. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, we've got a lot of things to discuss. We're going to be taking a look at cryptocurrency markets, as well as talking about the ongoing case with Craig Wright claiming to be Satoshi and own over 1 million Bitcoin. And outside of that as well, we have to take a look at traditional markets. And I want to spend some time to focus in on the awash of capital that is going to flee U.S. markets and talking about fundamentally, out of all the news with all the trade war worries and all the other geopolitical topics, why credit markets are what matter most. Anyways, we've got lots of things to discuss, guys. We'll get right into it right after our quick sponsor.
Our sponsor for this episode is Travala.com. Now, for those of you out there who are planning your next trip for either work or leisure, I highly recommend you check out Travala.com to place your next hotel booking. They not only provide a wide range of selections for places to stay along your travels, but also can provide upwards of 15 to 40% in discounts compared to other leading rates on booking websites. And to top it all off, you can use Bitcoin, Litecoin, XRP, and a basket of other cryptocurrencies to place your next booking. So if you want to learn more about Travala.com, check out the link down below in the description to find out more.
Alrighty, everyone, so let's go ahead and dive into the video and start off by taking a look at cryptocurrency markets. As we can see here over the last 24 hours, not only is Bitcoin down, but most cryptocurrencies across the board experiencing slight downward price action at the moment. Again, nothing too severe that we're not expected to in cryptocurrencies, and really closing down on what we saw the other day with Bitcoin propping up. As many of you might have already known, we talked about it in yesterday's episode. Actually, I really didn't get to specify what it was, but it was basically a short squeeze. Now I've talked about, the manipulation that goes on between whales and trading on BitMEX and leveraged exchanges and what they'll do to spot market prices in the short term. But that's about all the effective change they can have. And you can see markets don't really get affected on the way down. I mean, the prices will come back down to retrace on the gains that were, brought about because of that short squeeze. But really, there's no serious change in markets. We haven't seen any crazy amount of price action. We'll talk about why that's really relevant, as we've been hinting over the last few days. Bitcoin dominance here, still remaining flat below 70%. Still one of the most interesting indicators to me right now. I know it's a very simple indicator, not to mention as well, in the other coins index, we've got to factor the fact that there are stable coins, a lot of other things that we probably need to discount. So even more kind of beneficial, I think, to this idea that Bitcoin dominance is pretty high up on the chart as stable coins have become more and more of a picture in the overall space. As we can see here as well, still building a baseline support here at the range of support that we've had, as well as previous resistance back here. Going on, though, to take a look at the broader market, it's been pretty big in the sense of the bloodshed that we've had over the last week. Most prices are down for the most part. However, again, markets aren't too distraught, and we've also got some altcoins that have been holding in there well. Ethereum Classic popping up 22%, Chain 123%, Bitsy token, terrible exchange. Let's see here. What else do we have? I think there was Monetha as well, another small cap coin popping up. Icon coming back into action in full swing. And Ravencoin. I would say that the most interesting one to me is Ravencoin, because I know this is across a broad range of exchanges. There is no pre-mine. It's not some ICO. The buy-side activity we're seeing here is definitely much more organic looking to me than other players out there in the space. All right, this and Ethereum Classic have got to be the more interesting ones to me, because Ravencoin is one of my top 3 altcoins for this year. If you guys didn't already know and stuff, you guys might have already seen my video. And if you haven't, I recommend you watch my top 10 altcoin video, even if you guys might be skeptical as to whether or not there's going to be an altcoin cycle. I'm not 100% confident either, but I think that there's a lot of signs that are pointing to the fact that there is going to be some risk taking. We might get one or two more altcoin cycles until this market really starts to shape up and become more institutionalized. All right, so let's go ahead and talk about the current chart right now, and then we'll dive into some of the news. Not much has changed over the last few hours, guys. Again, markets are pushing sideways, but more relevant is the fact that we're pushing sideways into the tip of the wedge here. So I would expect the next week or so for markets to really pick up direction one way or the other. It could mean that we still have some correction to go, and we need to come down to the 200-day, which, bear in mind, is lining up very close to this price range here, this support range around 75, 7,400. So we might come down in the upper $7,000 range and find support. But I'll be honest, again, with the momentum we've had in this market, I think it's more optimal for this to break through. Again, might have some bias in that sense. I obviously am exposed to cryptocurrencies. I can't believe someone was leaving a comment the other day. Oh, Nick, you're trying to pump the markets. It's like, guys, I don't give a crap about that. Like, I'm in this for the next year or two, okay? And me saying something is not going to convince the whales who drive the short-term price to go, oh, yeah, I really should go out and buy 500 or 1,000 Bitcoin right off the market because Nick said something. I just couldn't believe there's some people who actually believe I have that kind of an effect on the market. I'm just simply telling you guys what I think is likely here. I'm looking at a very common technical pattern. It's a wedge. It's nothing overly complex. It's higher lows and lower highs, and it can go both ways. So the nice thing about this is if you do want to try to trade this, what you do is you wait for a specific or significant price on one way or the other of the wedge. So for example, at 12,000, I would consider this a good level where I would start to maybe add into my position to continue riding on the trend to the upside. If we broke down here, for example, and I was doing short-term trading, I would probably, sell out of my position at around, 9,800, somewhere around that, where it gives it some leeway to possibly visit outside the wedge like we had with a few of these wixes and see whether or not we're actually going to close below there, right? But again, I'm not trading these markets, guys. And quite frankly, even though I can't advise you guys to do anything, I know in my conscience I'm not trading for good reason. And that's because in this market, it's become a little bit more unpredictable. But I can tell you what's quite predictable and much more easier to understand is that Bitcoin moves in cycles, right? So I'm not going to rant and rave. You guys already know I've got my position on things. I'm long term, and I've already talked about it before multiple times in the past. All right, so I'm not going to dedicate much time to this because I've built a really good moral philosophy, guys, and I'd love to know what you guys think about this. And if this is your first time hearing it, I hope you guys will live upon it. If your life gets consumed by people who are wasting your time or just obviously in the wrong or just being stupid, don't let it consume your life. And in this case, I don't really spend time. I don't know the full details and extent as well, to be fair, of the court case that's going on with Craig Wright. But I want to go ahead and kind of talk about the headline piece that's come out over the last few hours in regards to this very long court case and also why it's insignificant in my mind. So the judge of the Craig Wright case has said hand over the Bitcoin to basically claim that he needs to hand over 50% of the supposed, I think it's 1 to 1.1 million Bitcoin that he has to turn over, a multi-billion-dollar amount of Bitcoin that he supposedly owns, in this case, to the other individual or the plaintiff of Dave Kleiman. So in this case, to just kind of summarize it, because again, I'm not going to be spending that much time to talk about it. To give a simple explanation, he's going to have to supposedly hand over half a chunk of 1.1 million Bitcoin, or around 550,000 Bitcoin. Now, this is really the funny thing here, because if you look at the market hasn't really moved at all. The only kind of price movement we've seen ever since this news is broke is really that we've kind of decayed on the short squeeze that we had. And that's understandable because a lot of this price action wasn't moved off fundamentals. There wasn't new buyers coming. It's just a short squeeze. And that's very common to what happens, right? So the market hasn't moved at all to this news that supposedly the person who owns Satoshi's original funds is going to have to move half of it to someone else. I'm pretty sure if that individual was Satoshi, it would move markets to a pretty large degree. And I don't think he is Satoshi. I think the markets know overwhelmingly that the court documents have been faked, that there is no proof of ownership of these funds. You know what, guys? I gotta come clean. I am Satoshi Nakamoto. I know. Who would have guessed? Nicholas Merton, a YouTuber, is Satoshi Nakamoto. I know. Now, I know what you all are wondering. Nick, when are you going to do the simple things that you could do to prove you're Satoshi, like signing on a blog post for Satoshi's blog, or maybe, for example, signing a transaction on the supposed 500,000 or 1.1 million. My apologies. I sometimes, just forget sometimes that I, wrote the Bitcoin white paper. Why wouldn't I just sign a transaction or sign a signature with my private key to prove that I'm Satoshi? Well, honestly, it's too much work for me, guys. And I don't actually have to work towards proving to you that I'm Satoshi. All right. I need to start living by my philosophy that I just stated. But again, there's a lot of like interesting, resources online that you can look into that talk about the Tulip Trust, that this court case is over, and really talks about the ownership of the supposed Bitcoin. And it's hogwash in my opinion, guys. It's not even worth the energy. This is the document here that supposedly talks about the deal they had where they exchanged like $100,000 worth of Bitcoin back in 2011, which obviously was a lot of Bitcoin, but I don't believe it. I really don't believe it. Until I see a signature, I'm not believing anything. There's so many easy ways to prove it. So many easy ways. All right, guys. So let's take a look at global markets, global futures across the board. Though nothing crazy significant for most indices, we are seeing green price action. This is following yesterday's upward movement in the market, obviously due to a lot of supposed news coming out in the sense of new deals being met. Now, there was some meetings with the G7 summit that supposedly led to some resolution, not just obviously from the comments we heard in the United States and China coming together, supposedly coming back to the table. I would say it's 50-50. I wouldn't really take much of that until we actually see some real solidified meetings and discussions coming up. But outside of that, in the sense of other global participants, the United States did reach some negotiations and discussions with other world leaders, meeting at the G7 summit. You can see here's a photo from the meeting. You've got a lot of big players here. For example, Abe from Japan. You got President Donald Trump. You get some of the economic advisors. You got Larry Kudlow in the background, Macron, Angela Merkel. And then we've also got Justin Trudeau and Boris Johnson, the new Prime Minister of the UK. So a lot of interesting things coming together in this meeting, a lot of powerful people at the table discussing about all kinds of different things. But one of the topics that they did discuss is trying to reach some resolutions and some policies on trade. And this obviously has to do with tariffs, subsidies, all kinds of stuff like that have to do with the pricing of goods and services and dealing with that between different nations. But again, this is what's led to, I think, a lot of the pop-up in the market here. I don't know if it's going to really last throughout the end of the day. I think the biggest thing that people are watching is China. But there's an even bigger topic that I want to talk about that isn't the trade war and that isn't being really talked about in the headlines in the media. And that is really the war between central banks. And this is something that's going to play out much more important than what's happening in the daily time frame for futures markets or how the market's going to open up today or tomorrow. This is something that's really going to dictate where liquidity flows in the long term. So many people are caught in the here and now. I want to focus and show you guys something that is going to play out over the next year or so. So let's go ahead and talk about it. So equities, even with all the fear going on right now, have actually, to be fair, held out quite well. We're only slightly down from the all-time highs that we've set on the S&P 500. Same goes, for example, with the NASDAQ, not too far off. Yeah, we've broken out of this ascending wedge, which is a bearish pattern. But quite frankly, again, some people might have their support lines down here, might say, it's still holding in, whatever. It's really not that far off from the highs here. A few hundred points down. Dow Jones Industrial Average, I'm not going to sensationalize it. Again, only 2,000 points down after a monstrous rally that it's had over the last few decades, right? Nothing too scary just as of yet. We have our targets. We expect it might go down in the long term. But why could it be that equities still are holding out the way that they are? Well, LMTR, a good data site that we check in from time to time, talks about how Wall Street firms have hit a 7-year high in allocation to the stock market. So even with the increased volatility, there has been increased exposure to U.S. equities, in fact, at a 7-year high, if you can believe it. So we're saying that exposure to stocks right now, in the sense of portfolio allocation, is at a 7-year high comparative to all the way back in 2012, where obviously markets were still quite cheap at the time. They hadn't reached back to all-time highs, and obviously, with inflation, you have to give some room for growth in the equities market because equities tend to adjust with inflation and they also tend to grow as well. But in this article, LMTR really talks about this being a contrarian indicator. And the reason why is that when analysts are overwhelmingly overweight in stocks, historically the stock market underperforms. But I think this speaks to something, as much as I do agree with him, this is a sign that we're towards a peak in the cycle. Doesn't mean that that peak can't hold out for a while, and it can't move up a little bit more over the next coming months. And why is this? Why is it that we're seeing this, such overwhelming demand for equity markets? Well, there's a lot of things that keeps it up. There's fixed income investments, basically where people are just, again, buying ETFs, buying into a basket of equities, and in the wave of trillions of dollars, not even questioning whether or not the market's in a good state, whether it's overextended or undervalued, and also what equities they're buying. They're just buying into it. And like a Ponzi in nature, it just continues to go up. I'm not going to call it a Ponzi. I mean, people are investing in it, but they're not asking whether or not the fundamentals are sound enough for these ETFs, things of that sort. That's the real kind of issue here. So this phenomenon has continued to grow. But there's things like that that have continued to keep the market going. You've got investors that are getting exposure. But why is it that institutional money managers are continuing to gain exposure to U.S. equities? Well, it's because the United States, comparative to other countries across the world, is in a very strong position. And that's not in the sense of its economy. I think you guys have probably heard me hint or talk about this before. I've talked about it recently with Alex Saunders from Nuggets News when we had our macro discussion on stocks, gold, and Bitcoin, and the whole overall kind of global market. And it's the fact that in the short term, the United States has found itself, due to tax cuts, deregulation, and a lot of the companies that people have wanted to have their capital parked in, they've had it in the United States, but it really has to do with one major factor. All those other things have allowed the central bank of the United States to be in a prime position comparative to global leaders. So here on the data that we have, and luckily recently they've added the People's Bank of China. I've been waiting for this forever because it is a massive central bank, the central bank of the second largest economy in the world. And we can see here that between the four major central banks, there's a very interesting trend. And I want to go ahead and give you guys a second. Take a look at this chart and tell me what you notice. What I notice here is that all of the world's central banks are coming together at a very similar valuation in the sense of their balance sheets. And there's one that's breaking the trend. And that's the Fed, the United States Central Bank. All of the world's central banks, at least these three leaders here, the Bank of Japan, the European Central Bank, and the People's Bank of China, have all come to an equal standstill at around $5.2 trillion in assets. Now, why is this, and why is it significant? Because, like interest rates, the central bank balance sheet is one of the many ways economies can provide relief, right? This is where central banks will buy up temporarily. They will buy up toxic assets, equities, treasuries, different things to say, hey, here's new capital, go lend it out, go invest it in the economy, and, well, go do what we know you're really going to do, which is buy up equities. And these economies have no room to lower it. And the only way that they're going to lower it in this case is if other nations are doing it, and vice versa. If one of these central banks starts to alleviate, let's say, for example, the ECB starts to do a new round of quantitative easing, the other central banks will probably follow. The Fed has been on autopilot when it comes to reducing its balance sheet. And so far, it's actually been pretty good for the U.S. Equities still pretty flat, right? And, again, I think the underlying economy has already been in a crappy position for a long time, and that's for the global economy. But for when we're talking about asset markets, that's the key here. From treasuries to the dollar and then even equities, the central bank has the leverage here. Take a look at the Fed here. We were at near 0% interest rates, around 0.25% over the last few years, and we've been able to rise up here to 2%. We went to 2.5 at the peak, and now sitting at 2.25. But take a look at the ECB. At 0% interest rates, dealing with negative yielding bonds because the rates start to go negative, the yield starts to go negative, right? Bank of England, basically the same case scenario, slightly better, not even a percentage point. And we've also got the Bank of Japan, negative interest rates since back here in 2016, a continued decline here from already low interest rates back in 2008. And the People's Bank of China is the only one that really stands a decent chance against the United States when it comes to rates, right? Because China has the room for it. It's been an expanding economy. They can have rates that are much higher. But if we take a look at the trend here, we've basically cut interest rates in half since 2008 and have shown no sign of increasing them. In fact, they've been declining throughout 2012 to where we are today. So, again, the thing to take away here is that the United States has the leverage. It has the leverage in interest rates. It's been rising rates. So dollar liquidity is shrinking because it's getting more expensive. And along with that, we have got a declining balance sheet for the Fed. Both of these are proven signs that the United States Central Bank has the strength in the sense of the dollar and the sense of its government treasuries for the federal government. So this means it can take on more debt, finance more debt. And then also, in this case, it is going to be a bolster for equity markets. So this is why, in my opinion, even with all of the craziness in the trade war, why equities are staying where they are. It's the reason why the U.S. can finance the near $1 trillion deficit that we're coming upon this year, and why it would probably be in the best interest of the United States to continue increasing that deficit in the short term. If they want to keep equity markets going, if they really want to take advantage of this interest rate scenario that we're in right now, there's a lot of demand that's going to come in from liquidity across the world into treasuries because they yield something. It's going to come into U.S. markets because it's not dropping like a rock comparative to a lot of equity markets. Okay, I'm not going to say they're dropping like a rock. That's maybe a little bit of an over-exaggeration, but the U.S. market is the best performing right now. It has been the best performing over the last few months. And as you know, equities have started to decline this year, U.S. equities hit an all-time high between the major three indices. So that's the key message here, guys. I hope you guys enjoyed this video. I know more than anything you guys are focused on the hedges, and that's really where we're going to see the money go, in my opinion. I think we're going to see, gold, silver, and Bitcoin and other cryptocurrencies alike that actually are building real products start to take over the scene and really become the asset classes that people look for. But some economies, as some of you have hinted out in the comments, cannot invest so freely in these hedging assets. So it's going to take time. It's going to be a matter of whether or not the financial sector, the regulators, and the money managers push hard enough for solutions to come to the forefront that allow people to gain exposure or easily gain exposure to cryptocurrencies. Well, whether they do or not, there's a lot of interesting products going out there in the cryptocurrency space, a lot of interesting tech that's coming to the forefront to help streamline crypto investment and getting people in the space. So I'm excited to see what people have in their minds for what they're going to do in order to get people into the crypto space and becoming their own bank. We've got a lot of interesting things coming down the pipeline, guys. I can't wait to show you what I've been working on personally in the later part of September. But until then, I guess we'll have to leave it at there. And I'd love to know what you all think about what's going on here. Do you really see eye to eye in the idea that U.S. markets are going to continue to hold out for a little bit longer because of this kind of new flush of liquidity or credit from other markets? I'd like to know what you think. Again, very interesting question here. When it's basically free or you get paid to borrow money, in this case, and you can send it anywhere you'd like, I would take some money and probably buy some equities. if that's the current rule set, why not? Even though it's not the case in the United States, it is for other global central banks. And money, as we all know, flows freely. It goes wherever it pleases, or at least wherever the owners want that money to go. Anyways, that's it for the video, guys. Thank you all so much for watching, and I will see you all in the next video. Stay tuned.